Silver just did something the market has been waiting for. It broke out, and it didn't break out quietly. It broke out in the middle of escalating geopolitical tensions between the United States and Iran. Tensions that are now being openly discussed on global news networks, in defense briefings, and across energy markets. Whenever headlines start using words like retaliation, regional escalation, military readiness, or strategic response, markets don't wait for confirmation. Markets move on fear. And right now, fear is moving silver. Let me be very clear about something from the start. This is not about predicting war. This is not about sensationalizing conflict. Markets don't require an actual war to react. They react to uncertainty. They react to risk. They react to the possibility of instability. And when instability enters the conversation, capital moves. Over the past several sessions, we've seen increased volatility across oil, defense stocks, emerging market currencies, and most importantly, precious metals. Gold began moving first. That's typical. Gold is the primary geopolitical hedge, but silver followed. And when silver follows gold during a geopolitical spike, that tells you something deeper is happening beneath the surface. Silver is not just a precious metal. It is both a monetary metal and an industrial metal. It reacts to inflation expectations, currency stress, bond market instability, and geopolitical risk simultaneously. When silver breaks technical resistance during geopolitical tension, it's not just a headline spike, it's capital repositioning. And here's what makes this moment interesting. Silver had been consolidating for weeks. It wasn't euphoric, it wasn't parabolic, it was building a base. Volume was tightening, volatility was compressing. That kind of price structure often precedes an explosive move when a catalyst hits. The catalyst may not be war itself. The catalyst is risk perception. Let's talk about why. When geopolitical tension rises in the Middle East, markets immediately price three things. First, oil risk. The Strait of Hormuz handles roughly 20% of global oil supply. Even the possibility of disruption sends crude oil higher. Higher oil feeds into inflation expectations. Second, dollar reaction. In early stages of geopolitical fear, the US dollar can strengthen as a safe haven. But if escalation threatens fiscal expansion, military spending, or destabilizes global trade, the dollar can weaken rapidly. Third, bond yields. If investors flee equities, they often buy treasuries. But if inflation risk rises simultaneously due to oil spikes, yields can become unstable. That environment, unstable yields, inflation pressure, geopolitical stress, is exactly where silver historically outperforms. This is not theory. Look at 1979 during the Iranian Revolution. Look at 1990 during the Gulf War. Look at 2003 during the Iraq invasion. Look at 2020 during the global crisis. Silver does not wait for official declarations. It moves when fear hits positioning. And that's what we're seeing right now. Silver didn't just tick up, it broke resistance. When a market breaks resistance during fear, that's not retail buying, that's institutional repositioning. And if this tension escalates, even rhetorically, the move could accelerate. But here's the critical question. Is this a temporary spike or the beginning of a larger macro shift? To answer that, we need to step back from headlines and look at the bigger structural environment silver is operating inside. Silver's breakout is not happening in isolation. It's happening in a macro environment that is already fragile. Let's connect the dots. The Federal Reserve is trapped between inflation and economic slowdown. Government debt has surpassed $36 trillion. Interest payments are consuming a growing percentage of federal revenue. Bond markets are unstable. Commercial real estate is under stress. Regional banks remain vulnerable. That backdrop existed before geopolitical tensions intensified. Now layer Middle East instability on top of that. If oil spikes meaningfully, inflation expectations rise again. That complicates the Federal Reserve's policy path. Rate cuts become harder to justify. Or if they cut anyway to protect economic growth, the dollar weakens. Either scenario benefits silver. Here's why. Silver responds to three macro forces: inflation expectations, real interest rates, currency instability. If oil moves higher because of supply fears, inflation expectations rise. If inflation rises faster than nominal rates, real rates decline. And when real rates decline, precious metals historically rally. At the same time, if markets begin to price in expanded military spending or fiscal strain due to geopolitical commitments, long-term debt sustainability becomes a concern. That weakens confidence in fiat currency stability. Silver thrives in currency doubt. But there's another dimension most people miss. Silver is a much smaller market than gold. The total above-ground investable silver supply is tiny compared to gold. That means when capital rotates into silver, price moves can be disproportionately violent. We saw that in 2011, when silver ran from under $20 to nearly $50 in less than a year. We saw it in 2020, when silver doubled in months. Silver is volatile by nature, but volatility during geopolitical stress tends to be upward volatility. And here's something even more interesting. The gold to silver ratio had been elevated prior to this breakout. Historically, when that ratio starts compressing during geopolitical tension, silver outperforms gold. That's a high risk, high beta move. If gold continues rising and the ratio compresses, silver doesn't just climb, it accelerates. And that acceleration tends to surprise people. Now, none of this requires full-scale war. Markets move on probabilities. If traders believe the probability of escalation is rising, hedging behavior intensifies. Hedging behavior means buying hard assets. Gold first, then silver, then mining equities. And we're seeing early signs of that rotation. But here's where we need to be rational. Geopolitical spikes often produce short-term surges. The question is whether this becomes a sustained macro theme or fades as rhetoric cools. So let's look at what would determine that. There are three possible paths forward. Scenario 1, de-escalation. If diplomatic channels reduce tension quickly and oil stabilizes, silver could retrace part of this breakout. Not collapse, but consolidate. In that case, this becomes a geopolitical premium that fades. Scenario 2, prolonged tension without direct conflict. This is historically the most bullish environment for precious metals. Ongoing uncertainty keeps oil elevated. Inflation expectations stay firm. Risk premium remains embedded in markets. Silver grinds higher over weeks or months rather than spiking and reversing. Scenario 3, rapid escalation with global market disruption. This is the most extreme outcome and not the base case. But if it occurred, volatility would surge across all assets. Initially, we could see liquidation as investors sell everything for liquidity, including metals. But historically, after that initial shock, capital floods into safe havens aggressively. In 2008, gold initially dipped before launching into a multi-year rally. In 2020, metals briefly sold off before exploding higher. Liquidity shocks can temporarily distort safe haven moves, but they rarely suppress them for long. So where are we right now? We are in early stage tension pricing. Oil is reacting. Metals are reacting. Defense stocks are reacting. But bond markets are not yet in panic mode. That tells you markets are hedging, not collapsing. Silver breaking resistance in a hedging phase is significant. It means institutions are allocating before full confirmation. And that's usually where the biggest percentage moves begin. But here's what I want you to think about carefully. Silver is not just reacting to geopolitics. It's reacting to accumulated macro fragility. Even without US-Iran tension, the structural pressures we're building, rising debt, persistent inflation, banking system vulnerability, dollar volatility, global de-dollarization conversations. Geopolitical stress is simply the spark. The fuel was already there. And when you combine a spark with dry fuel, you don't need a full-scale war to produce a sustained fire. Let's bring this back to you. This is not about panic, it's about positioning. If silver is breaking out during geopolitical tension, you have to ask, is this a trade or is this insurance? There's a difference. If you're trading headlines, you're trying to catch short-term volatility. That requires tight risk management. If you're positioning for structural macro instability, you're thinking longer term. Historically, silver performs in environments where inflation remains stubborn, real rates decline, fiscal deficits expand, geopolitical risk rises, currency confidence weakens. Look at that list carefully. How many of those conditions are already present? Even if tensions cool next week, the structural backdrop hasn't changed. Debt is still massive. Deficits are still expanding. Central banks globally are still net buyers of gold. And confidence in fiat systems globally is being questioned more openly than at any point in decades. Silver doesn't need war to rally. It needs doubt. And doubt is growing. Now, here's my question for you. Do you believe this breakout is purely a geopolitical spike? Or do you believe we're seeing the beginning of a broader macro repricing of risk assets? Drop your view in the comments. Because understanding market psychology right now is critical. The last time a geopolitical tension coincided with fragile monetary conditions, precious metals didn't just spike, they re-rated higher for years. And remember this, markets move before headlines confirm outcomes. By the time the news feels certain, the move is often halfway over. Silver just broke out. The fear trade is waking up. The question is whether this becomes a short tremor or the first shockwave of something much larger. Stay sharp, stay rational, and stay ahead of the curve. I'll see you in the next one.